What is going on, everybody? In this video, we are going to discuss how you can actually make money trading the range, using the opening range as a gauge for trend, profits, entries, exits, things along those lines. And I use this strategy today at the Apex accounts, about 3 grand across them. So, what do I look for? How do I set this up? And how can you set this up to give yourself an idea of what the market may do, where you could plot your entries and exits and make some quick profits along the way if you choose? So, what I like to do first is I jump right into the 15-minute chart. Then we're going to identify the 930 candle, which I believe is this one. I'm going to chart out wick high and then chart out the wick low. Okay, so here we have our 15-minute opening range. Then we go back to the 1 minute. And then you can start to see how things make sense. Now, mind you, it is just after 11:40 on the New York session. So we are trading in hindsight here, but this can give you a visual as to how you can play this to your hand. Now, mind you, roughly we had 9:30 open here. This is where the range was virtually established from the wick low of the opening print all the way up through here, right? But from 9:30 straight through 10:15, so almost an hour, you had choppy sideways action where people, most certainly blue accounts, took losses, got stopped out, and everything along those lines. But here is where the devil slowly comes into the details when you can start to add confluence to the trades to see where they make sense for you. So what you'll notice here is with the MACD pulled up at the bottom, we have our push up. Okay, great, boom. And then as we're looking here on the MACD at the bottom, if you're looking at my cursor, we start to have the cross. And then we push ourselves down. Okay, great. Then we came back up and we had our retest with another flush down. Came back up with a bigger flush down. But what are you noticing on the MACD? The retest to the upside become lower and lower, and the volume events down here signify that we are moving to the downside. Okay, so you can see that in my trades, we got short here. I like to look at the hanging mans or whatever, the hammers, whatever you want to call these candles here. We had a quick little scalp there. Now we had the push down, waited for the test up on this wick, had another push down. Okay, so now we have our range because we pushed up and then we retested and consolidated in this zone at VWAP or in the general range of VWAP. So when we're looking here, we're below on the MACD. Now we're positive on the MACD with this push up and we reclaim VWAP. With these two candles, as we start to swoop up, you can really see our move to the upside. So now we're back at the top of the range, and then we push back down, and now we're below range. But the point is, if you are looking at this strictly for the opening range, and I mean this range literally lasted the first 2 hours of the market. So price didn't really go anywhere. But if you're trading smaller size like I do, 1 to 3 contracts, and you can identify the bottom of the range here that was established on a push up, and then as we were below and the MACD started to turn around, you can actually start to see where you could take profits or find some entries and exits. To go one step further, you can also use Fibonacci retracements. So we'll just go from just below the range, because the cursor can get a little weird, to the top of the range. Okay, so that is the full range in itself. So just for the sake of argument, you have the 50% obviously right in the middle. But what this does, it helps us delineate the difference between discount and premium. Obviously, when you have price at the top of the range, that is premium. When you have price at the bottom of the range, that is discount. However, that will only hold for so long before the market has to make a decision, which it did here. And now we're headed way further into discount. And we may see a little bit of a retest, because if you look at the candle on a daily chart, we're actually pushing up. So you can delineate the discount and premium array from this opening range. So obviously you would want to buy below the 50 percentile mark here. And again, if you can notice and identify in these charts where we see some consolidation, I mean, these wicks here all bounced off this relative low, and then we had our push up. So even if you were getting in here and you bought, even at the higher end, let's say you bought at the closer end of the 50% mark, and you had to ride up straight to the top of the range, that's still a solid trade. So these are just some of the ways you can chart out your opening range or the range itself. It doesn't even have to be the opening range. This could be at the 2 o'clock hour, power hour, whatever it is. We see a lot of chop between 12 and 1 p.m., the lunch hour. So you can use this to really put yourself in an advantage where the market might be a little turtle soup chop action. But if you can find an area of discounted premium, either short at the premium or buy at the discount, you can get yourself some quick trades and go about your day. This is how you can make small profits compound over time and see the benefits down the road as your trading increases. So, guys, wanted to keep this video short. This is how I use the range today to make my profits. But please subscribe, comment down below, and I'll see you in the next video.